this video we're going to talk about two issues related to debt ratios. First of all, the weighted average cost of capital depends upon a constant debt ratio, which is actually something that is targeted by many companies. So the question comes up, how do you implement a constant debt ratio? Well, the way you do that is figure out what the value of the company is at every point in time. Take your debt ratio, multiply the value of the company by the debt ratio. That's the amount of debt that you need. So the way we'll do that is we'll work backwards in time. Starting with the last cash flow, the value of that, the period before the end, is that free cash flow discounted one time. Hang on. That free cash flow discounted one time. And whatever that is, 25% of that should be in debt at that point in time. Then we'll take the remaining cash flows, say in period 3, you take cash flows 4 and 5, find their value, 25% of that should be debt. So at any point in time, we need to take the value of the company's remaining cash flows times the debt ratio to get the amount of debt. Now it's easiest to just work this one cash flow at a time, working backwards in time. Starting with period 5, the value in period 4 is the value of 5 cash flow discounted once. If you have the value in period 4 and the cash flow in period 4, you add those together and discount one more time. It's easy to show you this in an example. So consider our project that has free cash flows 16,500, 5,100, 7,200, 7,200, 7,200, and 2,700. The value of this cash flow in year 5 as of year 4 is just discounted one time. So working through it, 2,700 discounted one time is the 2411 right here. Now, I'm going to store that because I'll need it in a minute, but multiply that by 25%, and you get the debt that needs to be outstanding in period 4 is 603 right here. But then what I'll do is I'll take the value in period 4 and the cash flow in period 4 and discount those together one more time. So the value in period 4 plus the cash flow in period 4 discounted is the value in period 3, the 8581. $25% of that is debt. That's the 2145. Going back one more step, the 8581 value in period 3 plus the cash flow in period 3, 7,200, discounted one time, is the 1490 value in period 2. 25% of that debt is the 3,523 value of debt in period 2. Take the value in period 2 plus the cash flow in period 2, 7,200, discounted one time, is the 19,009 value in period 1. 25% debt is 4,752. The value in period 1 plus the cash flow in period 1 24,109 discounted is 21,526, the value at period 0. So again, every period what you do, you should take the value in that period and the cash flow in that period, add them up and discount. The value in that period, the cash flow in that period, add them up and discount. The value in that period, the cash flow in that period, add them up and discount. Every time you multiply by the debt ratio, that gives you the amount of debt you need at every point in time. So that's how you maintain a constant debt ratio. Finally, often you are quoted a debt-to-equity ratio, not a debt ratio. Most financial websites will give you the debt-to-equity ratio. Now there's some reasons for that, but when we apply the weighted average cost of capital, we need the percentage of the firm financed with debt, not the debt-to-equity ratio. For example, in our company, the percentage of the firm financed with debt is 25%. The percentage of the firm financed with equity is 75%. So the debt-to-equity ratio is a third. But if you're given that the debt-to-equity ratio is a third, and you need to figure out how much of the firm is financed with debt, you need to go the other way. Well, the other way, it turns out, you just answer the question. If I want to know how much of the firm is financed with debt, you recognize that for every dollar in equity, there's a third of a dollar in debt. So the total amount of the firm is for every dollar in equity, there's a third of a dollar in debt. That's 4/3 of a dollar. And a third of that dollar is debt. So the percentage of the firm financed with debt, canceling here, is a quarter. For every dollar in equity, there's a third of a dollar in debt. And see, that's 3/3 over 4/3. So given a debt-to-equity ratio, you should have no trouble backing out the percentage of the firm financed with debt and the percentage of the firm financed with equity.